Welcome to Crescent Private Wealth's February 2026 market update. My name is Omar Bassal. Today we'll be covering the following topics. We'll begin with some U.S. economic news, followed by discussion on U.S. interest rates. We'll discuss U.S. stocks, followed by a discussion on non-U.S. stocks, and we'll conclude with some comments on commodities. So first, with respect to economic news, the U.S. economy grew at an annualized rate of 1.4% in the fourth quarter of 2025. This was down from the growth rate in the third quarter of 4.4%. This particular report was a little bit delayed because of the government shutdown, but it does show a cooling in the U.S. economy, but not a recession. In the month of January, the U.S. added 130,000 non-farm payrolls, so effectively new job creation. And one of the biggest developments in the last month was that the Supreme Court ruled the president does not have the authority to impose broad-based tariffs. So the tariffs were first announced on Liberation Day in April and resulted in significant market volatility. And then that was followed by several months of significant trade discussions between U.S. partners, and there were additional tariffs that were threatened and then pulled back. And now the Supreme Court has said that the heart of all of that is not under the authority of the president. Congress is the sole authority that has the power to tax, and therefore they've ruled them effectively illegal. Now, the president immediately announced a 10% tariff using another law, and that tariff has gone into effect. It's lower than the original tariffs, and it's only for a limited amount of time, but it maybe can be renewed. But that will probably also be challenged in courts. So the sum of all of this is that it's created significant uncertainty for businesses about planning. It creates countries are unsure of what if they can negotiate, if they're negotiating with the U.S. and then the entire basis of the negotiation becomes invalid. So it's all somewhat of a mess. Like even Europe said effectively, we're going to be placing our ratification of our agreement on hold. We don't know what's going on. We want to wait till there's more clarity. So, but it is a positive that tariff rates will be coming down overall, even though there's been the implementation of the 10% tariff. So this chart just give you perspective. It's about almost 100 years of U.S. average tariff rates going back 100 years, and you can effectively see how low rates had been for low and for long. So really from, let's call it maybe 95, well, really maybe 80, from 1980 through 2024, 2025, the rates had been below roughly 4% or 4% or less. And you can see that spike that occurred on Liberation Day. Now, the new rate, as I mentioned, is 10%. So we've likely seen peak tariff rates, but still it's somewhat of a drag on the economy. But I think markets are overall happy that it will be lower than some people had expected. Let's move on to a discussion on U.S. interest rates. So you have to understand inflation to understand interest rates, because inflation is, or interest rates are tied to the inflation rate. So when inflation is very high, interest rates will rise. When inflation is low, interest rates fall. So when we look at inflation, you can see that in January of 26, the inflation rate rose 0.2%, which was better than expected. And so the 12-month inflation rate is now 2.4%. The Fed wants it to be 2% or less, and that's seems to be we're moving in that direction. At the same time, the Fed's saying to themselves, well, the economy's still growing and there were 130,000 new jobs created. So how much lower do we really need to bring interest rates if if we're effectively maybe meeting our targets on both. So the Fed has two targets, looking at the economy, or growth of the economy, and looking at inflation. So this is one of the reasons that the Federal Reserve, when they met in January, they said, "Hey, we don't want to raise interest rates. Or, I'm sorry, we don't want to cut interest rates because we think things are pretty good as they are." And they kept the short-term interest rate, or the Fed funds rate, at a range between 3.5 and 3.75%. One of the interesting things that came out is the minutes of that meeting showed that there were a few members that felt that maybe the next move should be higher, that the Fed should consider raising interest rates. That's not the consensus. And keep in mind that there will be a new Fed chair in about 3 months. So it's likely that the Fed's next move will not be down, will not be up, it will be down. But it's interesting to note that some members of the Fed are of the view that maybe inflation, we've not got fully control of it, and therefore we need to raise interest rates a little bit to push it down. But at least in the short term, we can say inflation's moving in the right direction, and the economy is still growing. Therefore, probably the Fed is not in a hurry to do anything right now. This is a chart of the 10-year bond yield. So remember, the Fed controls short-term interest rates. What's an overnight rate, basically like a one-day rate. They don't control long-term interest rates, like a 10-year rate, which is set by the market. But what we can see here is that the 10-year rates have been declining. And so I think it's a sign that the market expects inflation to go down, maybe the Fed to cut more, which can can affect the long-term interest rates, even though the Fed doesn't control them. But if there's low short-term interest rates, typically you'll get lower long-term interest rates. So that's a positive sign for sure, for stocks, for risk assets in general, to see that lower interest rates, because the lower the interest rate, the more competitive, or the higher valuation investors give to stocks. Let's look at US stocks. So US stocks so far this year for 2026 are flat. So you can see here the S&P 500's up about 0.8%. The Nasdaq's actually down 1.6%. That's through February 24th. And we can see here that, interestingly, unlike previous years, the best performing sectors in the US are energy, materials, consumer staples. So normally we would have expected to see like technology or communication services in those top, but right now it's energy, materials, and consumer staples. One of the things of note, so let me mention about the U.S. market. The U.S. market is expensive. It's been expensive, and that somewhat contributes for the returns not being great. I think investors are wary of bidding valuations much higher. The positive narrative around artificial intelligence has shifted to a negative one. And the reason for that is that there are fears of obsolescence, effectively that industries will be made completely changed. As an example, there was an artificial intelligence application released targeting the legal industry. So suddenly many legal services potentially could be done by artificial intelligence, or certainly the amount of work required could be significantly less using artificial intelligence. And similar kind of apps have been released for finance and programming, and so these industries are changing, because suddenly you don't need a huge amount of workers to do write code. You don't need a huge amount of workers maybe to be doing models if artificial intelligence can do models for you or can do coding for you. So we've seen a big hit among some stocks, especially in the software sector, technology sector. So this has been a drag on the U.S. market. So let's look at the best performing sectors in the U.S. market just for 2026. So you can see here, energy is just on fire there. Materials, consumer staples, and then you can see on the weakest performing, it's been financials, discretionary, and technology. So very much a big reordering from what we normally see. This chart is showing you some of these key technology companies and how their fortunes have changed. So it's starting measuring from when ChatGPT was launched in 2022, and then you can see how initially there was this excitement about software and technology and implementation of artificial intelligence, and then in the last say 2 or 3 months, there's this change in views, and now people are really worried about these large tech companies like Salesforce or ServiceNow, Workday. What is their place in the future if so much of these tasks can be done by artificial intelligence? And so investors have kind of, shoot first, ask questions later approach, and that's resulted in these big declines across some large software companies. I think IBM, for example, is not IBM is not software, but it's affected by the AI wave. It had its biggest drop in like 25 years in the last week or two. Let's look at non-U.S. stocks. So unlike U.S. stocks, the non-U.S. markets have done pretty well. So non-U.S. stocks are up about 10% so far this year, again, going through February 24th. Global markets are benefiting from a weaker dollar, and they're benefiting from, they have lower valuations than the U.S. We discussed in our previous report about de-dollarization. There is another factor that investors are wary of owning U.S. assets, given some of the punitive actions the U.S. has taken against countries. For example, if you live in Denmark, and you're seeing your country kind of threatened, or one of your territories threatened by the U.S., do you think Denmark or Danes are going to put a lot of money into U.S. markets? I think it's, realistically speaking, they're going to probably not. And you can apply that same logic to Canada or to China, or so many countries that are seeing political issues with political problems with the U.S., and they just don't want to own U.S. assets. And so effectively, when you see this happening in mass, you're going to see U.S. stocks probably not do as well as non-U.S. stocks. There are other factors. Again, valuations, U.S. markets way more expensive than non-U.S. markets. That's also an explanation. But the reality is that there are investors that just want to have less U.S. exposure, given the unpredictable policies and the negation of policies that have been in place. It's just all kind of upside down. Finally, we'll mention here that that there is good evidence that the global economy is improving, and we want to mention that because if the global economy is improving, typically you'll get good returns in risk assets like stocks. So this is a chart of the performance of several countries from January 1st, 2026 through February 24th, 2026. So some of these numbers are kind of eye-popping. South Korea is up about 50% in 2 months. Peru, you see here, Turkey, Egypt, Thailand, Brazil, up 20+%. We're talking 2 months. And then if you look on the right-hand side, looks like maybe number 7 is the U.S. Out of this list. So clearly the U.S. is lagging. There's so much more interesting things happening in the U.S. in the equity markets when you look at Asia and Europe, even Latin America. So you can see here Peru done fantastic, Mexico doing very well. So this is just confirmation of investors' views, and I think this is not a short-term phenomenon. I think it's a trend that will be in place for a couple of years at least, as people kind of invest in these cheaper assets, and they kind of, at least for the Trump presidency, probably want to reduce exposure to the U.S. assets until they see maybe a bit more predictable policies. So this particular chart is showing speaks to the improvement of the global economy. So let me explain what you're looking at. There's a green line here, which is an indicator showing the health of the manufacturing on a global level. So the green line is giving you an indication is how healthy is the manufacturing on a global level. Now, one way to know if it's going to be if the global manufacturing is going to be improving or not, you have to look for some kind of a leading indicator, something that can kind of give you a lead of which way the global economy is turning. And the best, or one of the best leading indicators, is looking at small open economies like Taiwan or Sweden, because the way their economies are so geared to the global economy, they do so much exporting, that if there's any kind of weakness, they see it first, because they're going to start to see a slowdown in orders, and then eventually that filters through, and you start to see, um, the economy slowing down. But then when things are picking up, companies will place new orders, and those new orders are a lot of times will be intermediate goods that are being made or processed in Sweden or Taiwan or Singapore. And therefore, these small economies can give you really good indications of what's happening on the global level, because they're really leveraged to the global economy. So the darker line is a measure of the Swedish economy. And so if you look carefully at this chart, you can see that, like in 2007, 2008, before the global economy really turned down, the Swedish economy was telling you something's not right. You can see the similar story in 2019, let's say, where the Swedish economy was turning down well before the global economy. So even in 2022, the Swedish economy turned down well before the global economy. So the far right of the chart is showing you that the Swedish economy is actually turning up. So again, this is not one measure; it's many different measures of assessing the health of the Swedish economy. But you can tell that, hey, Swedish economy is turning up. More than likely, we're going to see the global economy turn up as well. That's very good for stocks. Finally, we'll talk about commodities. So as a reminder, commodities include things like energy, like say crude oil, natural gas. It includes precious metals like say gold and silver, includes base metals like copper and nickel. It includes agricultural, orange juice, cattle. And it's really important because these are things that people consume on a daily basis, largely, and therefore it gives you, commodity prices are a really great indicator for global economy health. Now, what we've seen recently in commodities is that they've been rallying, so commodity prices are up. One of the reasons, as we just discussed, there's an improvement in the global economy. The dollar has been weakening for some time now, probably will continue to weaken. That's the whole de-dollarization theme. There's tensions in the Middle East, which is pushing up energy prices. Central banks are actually have been diversifying into gold and silver. So that's another reason that we've seen a commodity, specifically precious metals, do well. So we expect commodities to do well in 2026, and this will be probably one of the ways we can generate additional return for our clients. So very briefly here, this is a Bloomberg Commodity Index chart. So this chart goes back a long time. So you can see here about, 20 years roughly. And you can see the ebbs and flows. But what's important to notice is that the last 2 or 3 years, global commodity prices in general have been flattish. And then say in the last 3 months, 4 months, you're starting to see that sort of pick up. And that's driven partly by oil. It's driven partly by gold and silver. And so again, all these are indicative of improvement on the global economy. Now, obviously, as a consumer, you don't like to see this because this is going to mean higher prices. But as investors, we can say that this is positive for investing in commodity stocks, but also positive as a indication of the health of the economy. Finally, this is the last slide I want to share with you, which is giving you an indication of why we could see significantly higher oil prices. So let me explain what you're looking at. There's 3 different lines here, and they're all trying to measure the same thing, which is how much spare capacity is there among the key oil producing countries for oil. So the reason that this is important is because there's a massive military buildup, U.S. military buildup in the Middle East, and there is a good likelihood that there will be what they call kinetic action, which is another euphemism for saying war. So if there is a war, people want to know how much spare capacity, how much can other countries cover if there's if Iran is unable to export. Now, Iran exports about 3 million barrels a day. And the message is showing you that there's not a lot of spare capacity in the event of a oil shock, especially given the fact that many of the key members of OPEC they use the Strait of Hormuz to ship oil, and that could be blocked off by Iran. So you could potentially see a massive spike in crude oil prices if God forbid there is a war. Thank you all for taking the time, and we look forward to sharing with you our thoughts next month.